calculate their numbers, understand their taxes, anything?
I don't love it, but I
do. Okay. Now, yes.
I just wanted to say this S Corp, C Corp,
Yeah.
whatever, you could write that down.
Oh,
I was gonna wonder
it's gonna
that
get
for
there.
years, but
Yes.
I never.
Yeah. Okay. You'll understand tonight. We're going to get there. Okay, so the rest of you that don't have a love for numbers, I'm going to flip y'all tonight. Okay, I'm going to make this super easy. It's going to get time for you to just understand how accounting affects your business, how taxes don't have to be scary, and how they can work for your benefit in your business. Okay? So, business entities. Okay? How many are LLCs? How many are sole proprietors not incorporated yet? A couple? Okay. So single member LLCs have one owner, right? And the purpose of the LLC is to give you the liability protection. The attorney that came in, Jahan, might have spoke to this as well. But it allows you to still operate like you are a sole proprietor, but it gives you that liability protection. So if somebody sues you, right, they can't sue your business. They can't sue your personal assets. They can only sue the business assets. So it's very important to at least do an LLC to get that protection. When you have an LLC, a lot of people run and jump and start a payroll for themselves. Especially when you see everybody trying to do a payroll. But when you're a single member LLC, the IRS doesn't want you to have a payroll for yourself because you're going to double tax yourself. You're going to pay tax on the wages, and then you're going to pay tax on the profit on your tax return. Okay? So what you do is you take draws. You just pull the money out, transfer it to your account, and you keep track of the money that you're taking out. And how you pay taxes on that money because it's not deductible. So I was saying, as a single member LLC, you take draws, not a salary for yourself, but you take draws. And that's literally just moving money from the business into your personal account. All right? And you just need to keep track of it because that money, the monies that you take out is not deductible. So the con that comes with being a single member LLC is that self-employment tax. How many of you know what that self-employment tax is on that tax? Yes. Okay. So any profit that you have, that 15.3% is going to be added on top of your, whatever your tax is at that point, right? With everything, there's levels. So starting out, right, the premise is when you're starting out, you're investing money into your business. So most LLCs, the goal is to have a loss in your tax. When you have a loss, it reduces your taxable income, correct? So you want to take advantage of that on your personal tax return while you can. Once you start making money, though, right, that profit, the moment that self-employment tax gets uncomfortable, to me is $1, it's time to consider converting. S corporations. S corps can be owned by more than one person. The owner can have a salary for yourself. You can have a payroll. No, you can't have a payroll for yourself, and it is deductible to the business. This is benefits of being an S corp. You can have up to 100 shareholders. The profit and losses are split among who owns the business. Okay. So the S corporation doesn't pay the taxes. The S corporation is just a reporting return. Whatever that profit or loss is, 100%, if you own it, goes to you. If there's two partners, you split it based on ownership, and it goes to them for their personal tax return. So when I was talking about considering converting from an LLC to another entity, it's not always an S corp, because if your business is making a lot of money, you still have to report that profit, right? Plus your wages on your personal tax return. So you have to work with a professional or look at it yourself and just determine which one is more beneficial. Because we know under Trump, right, corporations pay what? 21% flat forever. And they're trying to reduce it to 50%, right? So if you think about it on your personal tax return, if you have your wages and you have the profit for your business, you can easily go above 21%, right? So it's more advantageous to be a corporate. So an S corporation is applied for a little bit differently. You still set up the corporate estate, but the S corporation is just a tax preference. So you have to apply to the IRS to be treated as an S corporation. And the application is Form 2553. They send you an approval, and then at that point you are considered an S corporation. So it's not something you can just switch up and do. You have to apply for it. And because you're an S corp, your taxes are due in March, as opposed to April. And the reason they do that is because when you file it in March, you get the K-1 form that goes on your personal tax return in April. Makes sense? Get all. Okay. Some of the cons about corporations in general is the board. They like you to have a board that helps oversee the business. Shareholder limits, and all shareholders for S corps must be U.S. citizens. All right, corporations. Just talked about this a little bit. The benefit of corporations is it's completely corporate veil, right? You have total liability protection as a corporation, talked about the 21% tax on profits, and the biggest thing about corporations, check this out. Corporations can have losses, right? Say they have a $50,000 loss, right? They can save that loss and roll it forward to offset an income year. So when you hear about these corporations never paying taxes, they roll their losses forward and they never have to pay tax income. It's a beautiful thing.
That was a joke. Yeah, that was a joke.
That was a joke.
Oh, yeah.
So so you know how when we have a loss on our LLC, well, not LLC, but when you're an LLC or a partner, you have a loss, right? The loss is just for that year, it just stays there, right? A corporation can say, okay, we're going to take this $50,000 and we're going to just tuck it. And then next year when we make a profit, we're going to use a piece of it and offset it. So say it was $50,000 loss, I made $10,000, that profit's gone. And then I roll the $40,000 until it's all used up, right? And then if I have another loss, it gets added on. So just think about how these big corporations never pay taxes after taking. So that's why I say it's not always an S corp you want to bump to. It could be a corporation. Any nonprofits? Okay. I'll speak to this too. So nonprofits, we know, is a separate entity. They don't have owners, they have directors. There is liability protections. You're considered tax exempt. The important thing about nonprofits is that you file your taxes. You have to file your taxes with your status. All right. So even in a year where you haven't made $50,000, you still want to file even a postcard. Are you familiar with the 990N? Yeah. As long as you file that, keep your status. You won't have to reapply. Those taxes are doing that. So accounting, important for all business, and this is my heart. This is my conversation for you all. Because like you were talking about doing things early, and the stuff in place early, accounting is definitely something you want to do early. Now, talk a little bit about why accounting is important, but beyond understanding if you're making a profit, anybody that sells products, how do you know how much your costs are for your product, right? Because at a certain point, if you're paying too much for your product to make it, to sell it, you're hurting your bottom line, correct? So you have to know what those costs look like on your books. Your profit margin, right? Profit margin is the money you have outside of you putting money in to do what you need to do. So say you're a t-shirt maker. Your costs outside of that t-shirt and printing, right, that affects your profit margin. Can you afford to pay your staff? Can you afford to pay yourself, right? Is your cash flows enough to carry you through the month, through the loan? These are the things that accounting will tell you. So some best practices. I always like to give best practices because there's so much information out there and it doesn't have to be very complicated. So I'm going to tell you the things that you need to have an effective accounting system. Number one, business bank accounts. Everybody got a business bank account? Don't be afraid, this is no judgment zone. All right? The reason a business bank account is so important is because you want to show a separation from yourself to your business. As I was explaining a little bit earlier, it shows your assets, which is your cash, your accounts receivable, your fixed assets on the books, all your equipment and things like that, your liabilities, your bank loans, and equity. All right? And investors look at this because they want to understand the value of your business. All right? How much debt you owe, how liquid you are, all is presented on the balance sheet. The profit and loss statement is what they look at to see how your business is performing over the period, right? Or I should say, but the balance sheet is cumulative of all the years you've been in business. The profit and loss starts off new every year. So it's just for that period of time. And it's going to show how you're performing, what your revenues and expenses look like. And I like to just always explain that profits do not equal cash in the bank. There's tons of accounting apps out there. You want to find one that just helps you track all your revenue, right? That's all your expenses into one system. You have PayPal, you have Cash App, you have Venmo, right? And it's okay to have all those sources of collecting your money. You want to get your coins when you need to get them, but you want them all to dump into one account. And then another thing I see a lot of clients do is when you're moving money into your account to cover your expenses, you all had to do it, right? On your books, it looks like a regular deposit. If you give your documents to an accountant, we're going to assume that that is income that you should be paying tax on. If you're going to treat it as revenue, but it's not. It's capital that you put into the business. It's not taxable. So anytime you're putting money in your business, you want to make sure you keep it separate from your revenue. The IRS means whatever you consider ordinary and necessary for your business is deductible. Pulling over transactions every month, right, onto your accounting system. You don't need a bookkeeper, the system will do it for you. You run everything through that bank account. You're running your income, you're dumping all your PayPal, Cash App, everything's getting dumped into that account. Every expense, debit card, check, ACH, is running through that bank account. Why this is important is because you can give someone like me 12 months of your bank statements and I got everything I need about you. All right? You ain't got to search for a receipt. You ain't got to contact this and that to get things together. The most that you would need is an accountant, like myself or somebody who just specializes in accounting, to review it quarterly. Make sure transactions are categorized right so that you know quarterly how you're performing. So by the time tax time comes, you already know if you're going to have a profit or loss. You've got time to decide if you need to get that set IRA, right? Not pay taxes, but pay to yourself instead. You're going to have time to figure out, you need to buy that C-class, take that bonus depreciation and take advantage of it before tax time. You see what I mean? So the more that you know about your business early, the better you can tax strategize.